Okay, great. Well, I'm Ron Biscardi, the CEO of iConnections. Thank you everyone for being with us today. We are very excited to have a very prestigious panel of experts on banking and certainly financial crises. So several of these guys need no introduction, but I'll quickly tell you who they are. So today we have Danny Moses, founder of Moses Ventures, private investor and advisor, and also co-host of the On the Tape podcast, which iConnections is very proud to be a sponsor of. And Danny's also the former head trader of Front Point Partners financial services team, which of course was featured in The Big Short. Also with us today is Vinny Daniel from Seawolf Capital, which is a family office, used to be a hedge fund focused primarily on the financial services sector. Danny is partnered with Porter Collins, and just like Danny, Vinny and Porter were also a part of capitalizing on the housing crisis during the GFC, and were also chronicled in The Big Short. And we also have with us today an iConnections member, manager Ravi Chopra, founder and CIO of Azora Capital, a fundamental long-short equity strategy focused on the U.S. financial services sector. Ravi has spent the last 20 years analyzing financial services companies and successfully managed through the 2001 dot-com crash, as well as the GFC. And I now know is generally known as the best dressed man on Wall Street, and then living up to it even today.
Yes.
So anyway, guys, thank you all for being with us and for doing this on short notice. We really appreciate it. Obviously, we've had one heck of a ride over like in less than a week. At least for most of us, it's been less than a week. I have a feeling you guys are going to say that you've been watching this for quite a bit longer. But I thought we would start with Danny. Danny, if you could just tee up for us what exactly the situation was that sort of played out last week, and then we can get into what did the government do really over the weekend and today to try and get their arms around this thing, just to sort of level set this whole conversation.
And I'll bring Vinny and Ravi in on that as well. And I guess it was 96 hours ago, since the world changed. But I would back up before that. I would say that Silvergate was kind of the first warning that a bank, obviously in this type of environment, could fail given the product that it was catering to. But I think people kind of set that aside. That was just crypto. And then soon after, we saw the news out of Silicon Valley Bank. And just to back up a little bit, this was right in front of everyone for several quarters. Banks have to put out 10Qs like any companies and 10Ks. And so if anyone really dug through, you would have seen many banks actually that have this type of exposure to mortgage-backed securities, treasuries, and that's what banks do. They go out and they take their deposits, which are liabilities, and they go out and do things with them to earn a return. In the case of Silicon Valley, just call it bad risk management, bad everything, bad timing. They got too big and long duration assets. And I would say the difference, just to clarify, and these are treasuries and mortgage-backed securities, implicitly somewhat guaranteed by the government, I guess, if you want to say that, which they really are. And so from a credit risk perspective, this is more duration mismatch of liabilities, if you want to call them, leaving their balance sheet in the form of deposits, specifically with Silicon Valley, which catered to venture capital firms, which in the last few years have had trouble raising capital and had to dip into their cash on hand to finance operations. They were accelerating on the way out in terms of deposits leaving them, which made the mismatch look even worse. And it came to a head, because you can only hold these assets so long before the ratios start dipping to a place where you're going to be forced to raise capital. And this is not the right call to go into the regulatory environment for banks sub 250 billion and where that bifurcation takes place, because this could happen. This was on its way for months. So cut to the chase, middle of last week, they announced that they were going to raise $2.25 billion to basically fill what tended to be a bigger hole, but they were claiming a $20 billion sale of these securities, which created a $1.8 billion loss. Therefore, that $2.25 billion should suffice. Well, Goldman Sachs was the advisor to them. Obviously, we found out today that Goldman Sachs was the actual buyer of those of that $20 billion book. We save that for another show as well. And they rarely do you see in capital markets, and I tweeted this, Capital Markets 101, that you announce something like this without the capital actually being raised. And everyone on this call knows what wall crossing is. And I assumed, like any of you did, I'm sure when you saw the news that General Atlantic was going to buy $500 million, and there's a preferred offering, and that this and the other, you just assumed that the deal was already spoken for. You would never see something. So when they went on the quote virtual roadshow late last week, it was apparent that the money was not committed General Atlantic yet. It was conditional upon the rest of the capital being done. And then it became clear again, which was in front of all of us for the last several quarters, that it was a bigger than a $1.8 billion hit they were looking at. That was just the realized hit. And that's kind of how we got here. And then it became all of you on the phone and calling your funds and where you allocate, and Vinny and Ravi and so forth, already knowing this, calling analysts and saying, okay, just want to make sure I got this right. Run me a screen of banks that hold this type of asset. And then it was easy to figure out. And that's why you've seen the follow-on effect on First Republic and Signature Bank, which has a whole nother level of crypto attached to it. So that's my take. I'll turn to Vinny here a little bit to take that a little bit further, but that was kind of the opening setup here, prior to going into what the government actually did. But Vinny, maybe you want to go there.
Thanks, Danny, and thanks, Ron, for setting this up. A few things I would just add. Try to keep it simple in many respects. When you take interest rates from zero to where we are now, or were, 5%, there's a high probability that somewhere someone is going to be blowing up. We just don't know where it's going to be. And as Danny said, and we were speaking about this before with Ravi, is that as old financial services hacks who look at Qs and Ks, this was readily foreseen. Like when you looked at the balance sheet and you could see how underwater they were, as well as how levered they were. And yes, while it was not credit risk directly, that still doesn't change the fact that the balance sheets were underwater. So all of us were wondering, if and when they were going to raise capital. And it really was a question of whether the regulators were going to see what we saw, or whether they were going to allow them to get away with it. And I think the answer for select banks was no. The thing that interests me going forward, as I think about this, is that I think the cost of capital for everyone relative to the risk-free rate of return, because it's very possible the risk-free rate can decline, and I actually think it might, is going to go up. And as a result, I think everyone needs to think that their capital costs, whether you're an allocator, whether you're funding a company, it really doesn't matter. I think at the end of the day, particularly on the corporate side, your cost of capital is going to go up, because in general, banks are going to have to earn their return back. So that is something I think we all have to take it into account and consideration as we think about markets.
Ravi, why don't you give us your take on it, and then I've got a question or two.
Yeah, thanks, Ron, and Danny and Vinny. Thanks for letting me be with your panel. It's great to see you both. I would just maybe accentuate a couple of things that both Danny and Vinny said. And when I think about this cycle versus the GFC, and the recency bias is always to go back to the GFC, right? That cycle was about credit, right? And we know that credit is the first harm, and then it's liquidity that eventually kills a financial institution. This time around, it wasn't the credit risk; it was the interest rate risk that is killing the industry. And maybe credit will come in the future, but ultimately it's liquidity and interest rate risk taken together. And when I think about how we got here, it really stemmed from the pandemic, right? It stemmed from $5 trillion of QE. And if you put it into perspective, right, in the same way that consumers had money burning a hole in their pockets and they went out and bought Pelotons and they went out and bought boats and houses, these CFOs and treasurers also had $5 trillion burning a hole in their pocket. If you, in context, that's a 35% increase to system-wide deposits, right? And for certain banks, right, the crypto banks, Silvergate increased 8x in size. Silicon Valley increased 3x in size in 2 years, right? Banks don't triple in size unless they buy two other banks, right? It's very abnormal for that to happen. Signature, the same thing. And so there was a select number of banks that just hoovered in a lot of this 5 trillion. And instead of going and buying Pelotons and boats, they went out and bought securities. And I think that the magnitude we're talking about, Silicon Valley Bank was a $60 billion bank that went out and added $100 billion of securities. I think the magnitude is something that is really what created this problem. And of course, not one person, not one bank, not one regulator contemplated that, hey, we could actually see rates go up 500 basis points within 2 years after the pandemic, because the recency bias was after the global financial crisis, rates couldn't go up for the better part of a decade. It was so hard to finally get them up to 2 and 2.5%, and then they had to cut again, right? So it just wasn't in the psyche. And if you look at the stress tests, right, the stress testing that they've been so proud of for almost 15 years, right? What do? They stress test equity markets down 50%. They test down commercial real estate down 30%. Housing, residential housing down 30%. They look at unemployment going to 10%. They look at GDP negative 6%. What do rates do in their scenario? 10-year yield goes from 70 bips to 60 bips in the first year of their scenario. They didn't conceive of the idea they could go to 5%. And that's why the regulators were asleep at the switch, the treasurers were asleep at the switch, and didn't conceive that rates could go up this much. And we sit here today, and losses, just unrealized losses in the securities portfolios, both in the available for sale, which is backed out of most regulatory capital, and held to maturity portfolios, which is accounting, which is also backed out of most regulatory capital, is over $600 billion in the industry, which is about 15% of the capital equity, the common equity of the industry. And if you think about 15%, that's not all that dissimilar to the loss content that we saw from lending portfolios as a percentage of tangible common equity in 2008. So the size is there, but then the question is, like, can you hold these things to maturity or not? And I think what's changed a little bit in the world from yesteryear is in the same way that Bankrate.com, my mom just turned 80 on Friday, and she's not financially sophisticated, but I've taught her to go on Bankrate and get the high CD. So she can brag to me she just got a 4.5% CD, right? The speed of information, the ability to do that is much quicker. You can press a button. In the same way, we now have things like social media. And I can read Danny and Vinny's tweets, and I can also observe people who are VC firms and others who are getting concerned about things like funding and deposit risk at banks like Silicon Valley. It can start to feed itself on itself in a way that I think was less likely in years prior. And so, as these gentlemen already pointed out, this was already out there. It just seemed like people started to care. And then you start intersecting that with banks that have 90% of their deposits uninsured, and depositors never really thought they could lose money, right? That you're, as a depositor, you're always money good. The idea that you could lose money, I think, is a new one. And so that creates a run. And I think what happened last night, and I'll come to a close here, is what I think I wanted to hear, right? What I would have felt better about was what was called the TAG program, the Treasury Account Guarantee. Basically, let's guarantee all deposits, and I can feel good about leaving them where they are. That didn't happen. And unless that happens, and it might take an act of Congress for that to happen, then I think every corporate treasurer, every wealthy person is going to sit there and say, why do I have $1 more than $250,000 in an account? I could press a button and go sweep it to a money market fund. I can press a button and sweep it to a G-SIFI. And I think that's what you saw in the market today.
Let me just add, these trends were already happening. Jamie Dimon spoke last week at a conference to a bunch of investors and talked about 27% of the funds in the system have already left traditional deposits. This stuff was happening. I'm going to get these numbers off a little bit, but the math was pretty simple on Silicon Valley. They had, Vinny, correct me if I'm wrong, $12 to $13 billion in equity capital, and effectively an $18 to $20 billion loss on their portfolio, of which they only realized 1.8. So it was evident and right in front. So when they came to the table with this, the next question was, what else do you have? It was just a horrible way that they went about this process. I'm not saying it could have ended any differently. I think it could have been a little bit smoother and kind of put it. So I just wanted to put that in perspective. Vinny.
But back to Ravi's point, and this is where another thing that I think going forward is you're going to see, I would actually hope you see a very thorough regulatory review of how banks are regulated. A lot of the banks created in the middle when they owned very low coupon strike mortgage-backed securities and treasuries, set it up into a held to maturity bucket, which basically said, not to pick on them, but they just didn't want to mark it, and the regulators kind of didn't need to put it in capital ratios. But as we said, like guys like us look at footnote 6 or footnote 7, wherever it's sitting, and we see the unrealized mark. And I think one of the issues that happened with SVB is that we're like, okay, you plug the hole on the available for sale securities, and I apologize to get wonky, but you have this held to maturity book where if I marked it to market, you need to raise more money. And so any astute investor was sitting there saying, no mas, I don't want to know Roberto Duran style. I'm not doing this until you fill that hole, or at least that's what I would have done as an institutional investor. And I agree with you, Danny, they should have plugged the hole, but I don't think they really dotted their I's and covered the T, dotted the I's and crossed the T's in terms of, I think they thought they could pull a wool over our eyes, and they couldn't, and they did it. And that
this was, different product, but same type of scenario in Blackstone and their private real estate fund, Starwood and their private real estate fund. They've been hitting max redemptions of 5% a quarter now for roughly 3 quarters. If that had been a bank, there would have been a run on deposits there, right? And so this had already beginning. It's not just treasuries and mortgage-backed securities. If anything, it's actually, it's my point, when people start to look at banks now and really look at Qs and Ks before they take them on, as a partner, that to me has changed. And Ravi's point, and these two numbers have nothing to do with each other necessarily, but the trends are the same. Before QT ended, which let's be clear, it's over, okay? 600 billion was drained. It went from 8.95 trillion to 8.35 trillion. I'm not saying that's the reason, that the cause and effect, but Ravi just mentioned the number of 600 billion of basically assets. So the whole point Ravi made about, stimulus and QE and all this stuff coming into the system, it's somewhere. It had to go somewhere. So I find those numbers somewhat amusing.
I would just
Can I just ask one question quickly? So the idea that there were analysts that were looking at all these screens and you could see that these banks were approaching like a big problem. If you're the Fed and you've got this interest rate program that is a giant shift, right? We haven't done this for a decade. And now all of a sudden you've decided you have to fight inflation. You're going to be raising rates. And like they're sticking with it, right? I mean, they have not gone back at all. How have they not? Isn't there someone at the Fed who is looking at the same data? I mean, we've got Ravi's mom, looking at bankrate.com. Who's the person at the Fed who's supposed to be looking at these same data screens to do the same basic analysis? Because it certainly seems as if they weren't, because if you look at Powell's testimony from a week ago, it's like he's basically saying everything looks fine, and a week later we're doing a giant bailout. I mean, any thoughts on that? Like, how are the regulators this asleep at the switch? I mean, it certainly seems like they were.
Ron, can I jump in on this one?
Sure.
I think it's a function of it's not a single person at the government, right? Jay Powell's job is not supervision of the banks. I mean, technically he's the head, right? But there's actually a vice chair of supervision of the banks. And then there's a whole host of staff members that actually work on this at that level. And then there's the OCC, there's the FDIC, there's all these other local regulators that actually do the work. Jay Powell has a million other things going on, and he's not necessarily thinking about that as the first thing on his mind. He's got inflation to deal with. But I think the point you bring up is actually a fantastic one, which is tremendous egg on the face of both the regulators and the rating agencies, right? The rating agencies still had, A ratings until they downgraded Silicon Valley Bank that day, which sent it further into the death spiral. Yeah. And of course, we talk about the regulators not stressing for interest rate risk. I do believe an outgrowth of this, just like it was from the GFC, will be tremendously increased regulation going forward. And I think a couple of the easy low-hanging fruit was, one, we raised the stress testing limit from $50 billion to $250 billion when we did regulatory reform a few years ago, right? We can go back down to 50. And a simple thing is, and I think one thing that regulators and rating agencies start looking at is, what's your actual TC to TA and your tangible common equity, not excluding your mark-to-market losses, because the biggest banks don't get to exclude them. I think they're going to just lump everything together, including held-to-maturity portfolios, and say, what's your actual capital ratio going forward? Because we don't want to let this happen again. And that's something, by the way, that some of the European regulators do currently.
And a few things I would add, great points, Ravi. First, and I like giving proposals in my opinions, because I know I could throw out something that might be considered controversial, and absolutely no one in Washington, D.C. is going to listen to me. The first thing they should do is separate regulation from the Federal Reserve. That's the first thing I would do right there. Because as Ravi said, there's probably a tremendous amount of conflict of interest that when a staffer or someone, I'll bet back 6-9 months ago, staffers at the various regulatory bodies, whether FDIC, OCC, brought these issues up to the table. It's my guess. And said, hey, Bank XYZ has this issue, Bank X has that issue. And somehow, some way it gets pushed under the rug, mainly because politics go into play. You got to keep in mind these CEOs and executives are very powerful and they can browbeat back. And the poor staffers, like almost every other risk manager that sits in any fund or in the like, gets browbeaten and they get pushed down. So my guess is there was a lot of that. If you could simply, and I agree with Ravi, this whole idea, and this, I apologize for the wonkiness, but when they measure capital on a core tier 1 basis, like guys like us look at just simple, how much tangible equity do you have? How many assets do you have? And is it too light or too heavy? There needs to be more robust regulation. And it would be helpful if you separated the regulatory bodies from the people who are monitoring the monetary aggregates and controlling the monetary aggregates. It would make life a lot easier and a lot better, in my opinion.
And I would add to that, that if the Bernanke that we used to call on the trading desk was still, he would have cut rates today. He probably would have cut rates 100 basis points. And we saw this is a buildup of everything from 2009, 10, 11, 12. When we tried QE1, we had to do QE2. The market froze, reverse repo blew up a couple of years ago. We reversed everything. There was going to be a point where something was going to break. This just happened to be the big, I mean, you had 2 very large banks go out of business. And so I think to Ravi and Vinny's point, there will be regulatory action, whether that people like it or not. And so here we go again. And that goes back to the point we made early on here, just in terms of cost of capital, of having to charge more and risk weighting these assets differently, or liabilities should say differently. So.
Also, I should have mentioned this at the start, but if anyone has a question, just put it into the chat and we'll take a look at them and try and get to them. So guys, I think you can all see the questions there in the chat. This first one is quite long. So from Yasser Malik, I haven't looked into it, but were traditional counterparty risk management measures like CDS spreads and any other ratios help you see the spike? Just curious, as often counterparty limits don't have detailed look at financials. I assume each fund manager in private would have looked at their own treasury providers in the same way as public, but that assumption seems to have been misplaced. Any thoughts on this? What ratios on a dashboard for a counterparty like this would have been flashing red? Anyone want to take that?
I mean, widening spreads on mortgage-backed securities and treasuries going down and yields going up would be enough in something like this as far as counterparty risk. I mean, whether there was a one-off like Credit Suisse that had their own issues that had nothing to do with this, people do track that. During the global financial crisis, we were glued to fixed income in 2005 and 6 to see what was going to happen in equities. It took much longer than you think it's always going to take, and then it all happens at once. What is that movie that won 27 Oscars? Everything, Everywhere, All at Once, or whatever it was called. That's exactly the kind of the theme here of what's been happening. So there were always are nuggets of information that are out there that show you what's happening. And to the point, Ravi and Vinny can take where mortgage-backed securities are trading and literally put on a spreadsheet and apply it to the portfolio, which, to your point you made, Ron, what are the regulators doing? And Ravi and Vinny just told you that these banks that aren't the big banks don't have to do that. That's a mistake. And so again, right in front of you. And so there's a lot of ways to look at that. I mean, we talk about stocks outside of the banking system. The fixed income where their bonds are trading is always the best thing you can find, so to speak. And I was not tracking, Ravi and Vinny, I don't know if you were tracking some of the CDS in this world, but you could certainly track where their paper was trading, that was easy. That was sitting on their balance sheet. So I don't know if Vinny and Ravi have any other comments on that. But
The only thing I would add, it's kind of an odd twist, is that, the banking system is supposed to be, particularly deposits, supposed to be sacrosanct. You're not really supposed to worry about your deposits that sit at a bank, simply because we view that as cash. Now, I understand there's a percentage of uninsured, and it's like, I think that's where some of the regulations went awry. But in general, you could have looked at things like junior preferreds as well as some of the debt levels, Danny. But the reality is people who are running their businesses, they naturally assume and understandably assume that the banks where they're doing business are fine, because there are regulations behind it, and there's capital behind it, and there's insurance behind it. And that's where I think there was a real flaw in the model, in that this was not supposed to happen, where 2 days or a week ago, Silicon Valley, the stock's down, but so is everything else down, particularly in tech land. And you went from a stock that was trading at $200 to zero in 3 days, right? That's not supposed to happen. And if the regulators were doing their job from jump, it wouldn't have happened. So,
I mean, I'll say, as a small business owner, like, I have a little bit more sophistication maybe than the average small business owner. So, when I chose a bank, I was thinking about the credit worthiness of a bank, but I think that is very rare. I think most small businesses, they're just like, they're banking with, a place where they have the right relationship to move their business forward. Like, that's the primary, probably more so than, they're certainly not looking at, credit default swap spreads on the bank before they choose it. I think for the most part, like, is it possible to get the system to the point where your bank is more of a utility to the economy than it is, because, like, I think, and, you're talking about Silicon Valley Bank, where you had a ton of sophistication around it, right? Like, all that money was venture money, or certainly a lot of it. They had access to the right minds. I think those people were just thinking, like, this is how I'm paying my bills, right? Money comes in, I collect my revenue, I send out money to pay my bills, run payroll. They're not thinking that I'm actually lending money to this institution and it's going to go take some level of risk with it. Is it feasible to move away from a system, the kind of system we have, or create another branch of it where for the average business owner, I would be happy personally to pay the bank, not make any interest on the cash, but just pay the bank for the service of keeping the money safe and allowing me to conduct my business. Is that even in the head of anyone in Washington, that kind of a concept? Because I feel like in other countries, they have gotten to this, maybe not by calling it a utility, but like in Canada, what do they have? 6 banks? We have 2,000. I mean, like, the 6 banks are not going out of business in Canada, right? Like, no matter what happens, they're not letting those banks go under.
I don't know if you guys want to answer that. Rob, you want to give it a crack? I have my thoughts on that too. So
Go ahead, Danny, go first. I'll go after.
no, I was just thinking that that's great on paper, Ron, and you saw what happened in 2008, where you take what are insured deposits effectively, and then you go and prop trade with them, and that's not what the intent was, and that was, people were punished, not enough, obviously. And to your point, should they just be some type of utility, basically non-for-profit? That's not the way the incentive. That's not the way the system is really obviously set up at this moment. And it is what it is. So we need to adapt. Right before we got on this call, Vinny and I had Porter Collins on the phone, and I'm very anti-bailout in general, because I believe that the whole moral hazard thing that's been created, I think things should clear at the right price. I was very frustrated, obviously, back in 2009, 10, and 11, that we didn't clear things, and we've allowed this thing to kind of build up. That being said, on a relative basis, in this particular case, Ron, I have pure sympathy, empathy for any small business. To your point, the last thing they should be worried about or thinking about is that the money, that they have thousands of employees. And I think that's where the White House finally started to figure out, hold on a second, this does hurt average Joe, because the top part, maybe you want to teach people a lesson in Silicon Valley, but the truth is these are thousands and thousands of businesses and tens of thousands of jobs. And so it's just not right. So to Robbie's point he made, I think at the very beginning, if you just guarantee all deposits, the bank would have gone out. Everyone would have said the bank deserved it. But the repercussions, obviously, with what the current system is that it's just not fair. And I believe companies were missing payroll. I mean, that's not right. That's not kind of the American way. And so I know a lot of people go back and forth, but relative to everything that we've done from a bailout perspective in the last, we're not going to do that. And so, I know there's a question in here about contagion and, how do we stop that how do we stop our banks a buying opportunity? And unfortunately, I think that the bigger banks, this is not what Washington wants. The bigger banks are going to get bigger right now. And that, I think, is going to be the big challenge here over the next few years is how do you come in, and Ron, to your point, how do you kind of separate these banks and maybe, good bank, bad bank, so to speak, which is what everyone tried to do at the end of the global financial or during the global financial crisis. Don't look here. Let's take this bank and put it here. This is the lending vehicle. This isn't. So I could go on, but I think that's kind of where we're headed here. So Vinny, Ravi, please chime in on that.
Yeah. Thanks, Dan. I agree with everything you said. And maybe just to add on, there was a question earlier about counterparty risk and what indicators to look for. It's really not rocket science, right? Like these bank securities portfolios are 5-6 year duration portfolios. Rates go up 300-400 basis points. You just do that math and you have a 20-25% type loss in the portfolio. And to your point, Ron, does that mean that that's a highly credit worthy bank anymore? And so far the rules have said, yes, they are as credit worthy today as they were 2 years ago before this rate movement happened. And you have to ask yourself, does that make sense? The answer is probably not, right? And so I think in terms of, look, the banking system is by nature a fractional banking system. It's kind of like the US dollar. It's not backed by gold, but as long as we all kind of are in it together, then it still works. And the same thing with the banks, as long as there's confidence around each other, we're going to keep the deposits there together, then it works. And I think if you don't do that, then you're going to have lending that doesn't happen in the economy, which would not be great. But the reality is that returns for the industry now have to come down because we now have to address this problem that we somehow put our blinders on and pretend it didn't happen or was not happening. And so what that means most likely is capital raises that will come over time, right? Maybe not this week, but over time, there's 15% of lost equity to the system from these moves, these marks, then they probably have to raise some modicum of that over the coming period. We will again not look at back things out and for held to maturity counting or anything along those lines. And we'll have to think really hard about liquidity and hold a lot more liquidity, much like the big banks do for the smaller banks as well. All of that, and we're going to put more money into the deposit fund, right? The fund that guarantees deposits, right? So that's going to cost more money. All that means a less profitable banking system going forward, but hopefully a safer one, to your point, so that your small business and others don't have to worry.
Yeah,
I do think, like, I do think it means they're probably going to have to charge more. That goes back to my initial thing of cost of capital. And what I would like to see is the banking system. And I know everyone has felt like they were well capitalized, much better capitalized during the prior to the Great Recession, and that is all well and good. The problem is they lumped on a lot of assets. I would rather see a more robust banking system where they're not allowed to do that as much as they did, particularly when you take on the risk. And if that means they have to charge all of us a little bit more to make their return on capital, because that's the way our system is set up, so be it. So if we have a healthier banking system where they can make an adequate return on less leverage, I'm fine with that, right? And that means they're going to have to charge more for leverage. And so one of the things that really bothers me is that there's these large pools of capital in asset management firms that are levered between 5 and 8 to 1, right? And they're getting their leverage primarily from the banking system, right? I think they need to charge more. I think they need to charge a lot more, right? And as a result, maybe the leverage of the entire wealth management, asset management system needs to come down. And that'll be like not tomorrow, because you can't do it tomorrow, but over the next 2-3 years. And that'll be a really good thing for the health of this country overall going forward, my opinion.
So obviously we've got an audience of fund managers and pools of capital being allocated across the investment world in our audience. So an obvious question here, what are the risks and opportunities here? How can you capitalize on this? And also, what do you think the real likelihood is of systemic contagion harming the real economy? Anyone want to jump in on that one?
Then you want to go and
Well, I think I don't know if I necessarily call it contagion, but obviously on an all else being equal basis, we're going to have a slower economy as a result of everything we just said, right?
Mhm.
So I also think that we need to ensure, as Ravi said, and nip it on about any fears of a deposit run within the banking system. He said, we live in a leveraged fractional banking system. You cannot have the fear that your money parked in a bank is going to go to dust. We have to stop that. And so as a result, I'm hoping they get ahead of it. What they did on Sunday helped, but I agree with Ravi, it did not completely eliminate the potential risk of it. Yes, banks will be backstopped and they will have the availability to get credit if they're on deposit runs. But that's what Ravi was speaking about in terms of guaranteeing all deposits, which is a very somewhat controversial, although we could have a discussion on it. But there are two different things right now, what we have, and they probably need to address that.
You
Might
can't-
be an act of Congress, though, right?
yeah, you can't guarantee all deposits until you get the banks in order. If you guarantee all the deposits, they'll go haywire with them because then they'll
Right.
realize that, I think that they'll use that as an excuse to go out and take more risk potentially. I would say bringing it back kind of to the macro view coming out of financials, I would say that this has been a financialized, economy for decades. I mean, everything is really tied to the financial system. So it starts and ends with the banks. We can pretend it doesn't, but it's the root of everything, good and bad. When you think about auto loans and student loans and credit card, securitizations, and those all have a cost of capital. And these are the banks that lend to the companies to go out and get those loans and then package them and sell them. And it's all related, right? It's all kind of related. From a macro perspective, if the Fed is indeed done, and this is the quote rally, if that's what you want to call it, from where it was today, Fed was going to stop at some point for the reasons of stopping here is not great. And it couldn't come at a worse time. Just to pull it back even further when, we're looking at the $32 trillion of debt and so forth. So to Vinny's point, if the economy starts to slow down sooner and harder as a result of this, the picture just becomes harder and harder. And so I don't want to use this call for that, but I could paint that picture. There's always opportunities. And I think that companies in general, especially with yields coming back down again, that pay the dividends, that have paid dividends for decades, that know how to manage through, that don't blame the Fed, that don't use inflation as an excuse and just manage their businesses and have pricing power just to kind of bring it back. There are great things that are to own here. And the last thing, and I'll let Ravi comment, is that I think the passive investing era, obviously it's never going away. It's a massive part of the business. And most people that are on this call, like active investing, I'm sure for the most part, and I know Ravi, Vinny, and myself do. And I always bring this up, and it's really enough with buying the XLF or shorting the XLF. I mean, if you look at what comprises it and so forth, there's so many longs and shorts within that. But I think this is a real wake-up call for active money management. I think it's a wake-up call for bottom-up fundamental analysis, and there'll always be things to buy. And Ron, you just made me think about something. When should banks become utilities? And the truth is, in a perfect world, yeah, we pay our utilities. They're public companies. They pay a dividend out. They have an ROE, which they're required. They're supposed to provide a service to us. So yes, in the perfect world, yeah, I would think so. So anyway, I probably went off a little bit on a tangent there, but from a risk, there's always opportunity, I guess, is what I'm saying. So I just think this pulled forward the inevitable of the Fed stopping and then getting a real look at what's really happening in the economy. Ravi.
Yeah, thanks. One of the things that Vinny said earlier was leverage is going to have to come down in the system. The cost of credit is going to have to go up. You think about a bank going out and lending to a commercial mortgage REIT, which is then, making loans to developers to refurbish buildings, stuff like that. Well, I have to imagine with everything we're seeing, the cost of all of that is going to go higher and make it that much more expensive to do all those activities. So I think all of that conspires for some as he pointed out, economic slowdown relative to what we would have had otherwise. I think that within that, I also agree with Danny that this is probably one of the best last year, this year have been one of the best opportunities for stock picking I've seen since the GFC. You see, days like today, things that actually make sense, right? Stocks that have real risk down 20, 30, 40, 50%, and those that have really great balance sheets flat, right? So I see that in my world. And if there's someone who's going to benefit from people moving money out of banks to safe places, it's probably someone who has money market mutual funds, right? So these kinds of opportunities, I think, are magnified when we have these dislocations in the macro and the micro like we have now.
What any comments on First Republic, which is the one that people clearly were focused on over the weekend as the next domino to fall? I think the stock dropped, I don't know, was it like 50% or something today? I mean, it was bad, 61%. I mean, that's a bad day.
Very.
I don't know if you guys know this one, well enough to comment on it, but
We're financials guys. We're financials guys. We know it pretty well.
Okay.
The interesting thing about First Republic Bank, it was always a bank for me that was because the way my head works, it was always too expensive for my liking because it was viewed as a growth bank and it always traded at a higher multiple than I would have liked. I can't say that's the case anymore, but the one thing they do have, right, is a great franchise, a great retail franchise. If you ask anyone who banks there, they love their banking relationship. So this is a long-winded way of saying that the brand and the service is worth something. At least I would think it's worth something, assuming there's not a deposit run that really drains the value of the brand. So, we were sort of just brainstorming, me and a bunch of friends today, like if there is not a material deposit run, who would want to acquire this bank at a discount, right? Probably a discount to face and book value. That would be accretive to their own brand because it has been a well-run retail bank. It just was too expensive for me. But that was my initial thoughts on First Republic.
I was just going to say, I haven't been shorted. Not long it. I'm watching the action in it. It's to Vinny's point, it's great franchise and everything's kind of out in the open right now. So I think if they need to, this is my point about JP Morgan or some of the bigger banks getting potentially bigger. That's an easy M&A, right? Possibly. But you're certainly going to have to see capital raise. I would think if I'm looking right now, maybe it could come any moment. I have no idea, but they got exposed just on the comp to Silicon Valley and looking at their portfolio. And it's easy to see Schwab is the same. Schwab has a massive hole relative to the size of its capital. And I can tell you as a Schwab customer, to Ravi's point of Federated or whatever it might be, I opened up this morning and in my account, and I tend to trade and it settles and whatever, but they had set up two separate banks today. I've never seen Schwab Bank and Schwab Premier Bank, and each were under 250,000. They quote, did it for me, which is very odd, which scared me even more, which made me immediately buy treasuries with it. So I mean, I swear that's true. And so you think Schwab has this bank, right? It's not hard to the point Ravi made early on. It takes a click right now to do it. And so that to me, I think they're going to have to raise capital. I don't see how now. I say that treasuries have pulled in, 100 basis points on the 2-year. The whole curve is flattening a bit and coming in. So yeah, they're mark to market. All the mark to market got a little bit better. In that right after the Silicon Valley sale, which was the reason that we probably saw treasuries shoot up like they did because the markets. And that's the other thing for a market that's supposed to be so liquid. You talk about the U.S. Treasury market should be the most liquid place to trade on planet Earth. You have 40 basis point moves in days. Not even on. I mean, yes, today maybe you call it an exception, a sigma event of some kind, but yeah. So that type of volatility is very hard to manage risk as a bank, as a portfolio manager, as whatever, because your input one day, oh, I'm using 4% on the, well, no, use 3.8. No, use 4.3 as you're projecting. So again, someone asked a question in there about hedging and why didn't Silicon Valley hedge out their book? And, and they, it's a great question because the big banks do that and the big REITs do that. The mortgage REITs, that's how they live. They manage duration risk and things like that. So it all really is, Ron, back to your point, or what are these companies set up to do? And they're set up to lend and pay and take care of their clients. And that's just has gotten away from us the last couple of decades. So.
So Andy Fish has a question here. How much of this is the 90-day bill being 0 1 year ago and for many years, where leaving cash in a bank didn't matter, and in a single year that goes to 5% today, where there's a huge incentive to shift cash away from a bank?
That's it. Next.
That's it.
Yes.
No, I'm gonna add to that.
Yeah.
Right? This is where I think the regulations went awry, and Ravi was getting to this. So when you see an influx of cash from COVID pandemic stimulus come into the system, right? And you have an artificially high amount of deposits in the entire system. What the regulator should have been telling the banks is that money, even though it's DDAs, meaning zero interest bearing deposits, it's probably hot. So don't you dare extend duration on the left side of your balance sheet and buy maturities so you can tell me and Ravi that their net interest margin beat us by 3 basis points every quarter. You're not going to do that, right? So what they needed to do was to hold short duration assets, and at that time yielding minimal, whether they liked it or not. And this is where regulation goes awry, right? Because the CEOs fought back. They probably said, look, on a core tier 1, I'm fine, so leave me alone, right? But that's where I would have done and say, I don't care, mofo, this is what you're doing, because the safety and soundness of the country and the deposits is what my job is, not to make sure that you get a higher compensation by beating net interest margin by 3 basis points every quarter. So
Jeremy Strong would have been proud of that, Vinny. That was very, very good. Sorry. Yeah.
What about cryptocurrencies? The question is, what do you think about the impact on cryptocurrencies and people's options of various financial platforms? And also, do you think this incident will impact international startups' ability to access U.S. capital markets?
I mean, I think international startups that are good, anything that's good will find money somewhere. Believe me, banks are looking for places to help and lend if it's or help raise capital for. I won't comment on crypto. Obviously we've seen kind of what's happened here. Crypto needs regulation. It's begging for regulation. And the whole concept of it is don't regulate me. So somewhere that's going to marry, and hopefully there's a middle ground there, but I don't know if Ravi or Vinny want to comment on that. But I think I just want to say one other thing. It was evident that when you have duration mismatch of an asset, and Silvergate was firsthand, that can literally disappear overnight, and you have liabilities in the form of crypto on your balance sheet effectively, or coins, and then you're going out and using that money for long duration investments, that really doesn't work, and that can blow up on you quickly. So
I would just say that I don't have a particular view on crypto, but as it relates to financial services, it's been very clear that in the last number of months, a broad set of regulators have decided that they don't like this and they want to hive off crypto from the financial services industry. Whether it's the joint statement from the Fed and OCC saying we really are going to watch crypto digital type concentrations at banks and beware if you have a lot of them, or it be the SEC who wants to declare a lot of things securities, including stable coins. And so I think Silvergate failed for good reason. I think that Signature had the makings of a failure and a bank run. I wouldn't be surprised that they didn't necessarily have to be the first one or the next one after Silicon Valley Bank, but I think that 25% of their business was crypto, and they ran something called Signet, which is a internal kind of wire system that probably had a lot of nefarious activity on it, I think it was a great excuse for the regulators to take that name down as well over the weekend.
That's interesting. Yeah, just let's knock this problem out also while we're at it.
I mean, can I just say this? It's kind of interesting that for a little tidbit, Silicon Valley Bank CEO Greg Becker was actually on the San Francisco Fed board, and Barney Frank, who wrote the Dodd-Frank Act, who re-regulated financial services, is on or was on the board of Signature Bank that just failed. So a couple interesting twists for you.
That's a great pattern. There didn't Silicon Valley Bank also have, wasn't there a recent risk manager?
Lehman.
That's what it was. It was
Yeah.
Lehman, right? All right, great. Well, we're almost at time here, guys. Any parting thoughts on how to navigate this?
I'd just say that I think most professional investors and or allocators that have investors themselves have sent out emails or told, where we have our money parked or our portfolio companies are doing this. I think you'll keep seeing more of that. I think that's the right thing to do to kind of get in front of it. And I think I wouldn't stop there. I would, even the banks that you believe don't have counterparty risk, just because the government's come out with this program, if you want to call it that. I think there's more work that needs to be done here. And I think that there's other assets, other issues at some of these banks, which pose not maybe immediate risk, but still pose risk. And so I think we're still at the beginning stages of an economic downturn. And with that, it's natural that there'll be other products that are implicated. So it's a deep breath moment in general is my last point, but I think it pays to be vigilant here in all aspects of your businesses. I really do.
My suggestion to all of them is listen to your risk managers now. Just really, like, they probably have a firm understanding of some of the risk associated with your organization. And rather than dismiss them as doomsayers and the like, what did we say? The cynics and the conspiracy theorists right now are batting about 1,000 over the last 6 to 9 months. Just listen to them, see what they're thinking, and really incorporate it into your business practices right now.
My parting shot is I'm going to give a shout out and a props to the podcast that Danny's been on, sponsored by iConnections, that often hosts Vinny, and I've been listening to it. It has been a helpful resource. So for those who are looking to navigate the markets, I would check it out. It's called On the Tape.
Well said. All right, guys, I really appreciate you taking the time. Thank you, everyone, for joining us, and
Our pleasure.
have a great day. Good luck out there.
Thank you.
Thanks, everybody. Thanks, Ron.
Thanks. See you guys.